Going to look at a 5-minute, easy to understand, simple to follow, high probability scalping strategy. Now, for those that don't understand what scalping is, basically means we're on the shorter time periods. We're looking to be in the market and out of the market very, very quickly, hoping to take 10, 15, 20 pips out of the market. Multiple opportunities throughout the trading day, as opposed to intraday trading, where you might be looking at the 1 hour chart or the 4 hour chart or the daily chart. So scalping looks at the shorter time periods, and we look to get in and out several times a day. Tight take profit targets and tight stop loss targets. Now, what I'm going to do now, I'm just going to give you the outline of the strategy here on the whiteboard, but then we're going to go on to the charts, and I'm going to show you the setup, the confirmations, and everything that you need to know so you can go out and test this strategy and then start trading it with your real money should you wish to do so. Now, there's two possible ways you can exit. I'm going to show you both of those when we get onto the onto the screens as well in a moment. But this is the basic premise. Now, this is a trend following scalping strategy. That basically means we're going with the predominant trend. We're waiting for pullbacks, and we're looking to get into the market on the shorter time periods as the market pulls back, with the predominant trend as our direction. Now, as with any strategy that I trade, I always look for the higher time frame confirmation. In this example, if we're trading the 5-minute chart, we have our confirmation chart. I call it the anchor chart. Now, the anchor chart here on this 5-minute strategy is going to be the H1 chart, the hourly chart, or the 60-minute chart. That determines which way we're going to be trading. Are we going to be buying or are we going to be selling? And I use two exponential moving averages to give me an indication of which way the market is going. I look at the 8 exponential moving average and the 21 exponential. We need to see price the right side of the moving averages to confirm the direction of the trend and indeed what we're going to be looking for on the shorter time period. So here we're only interested in sell opportunities. So we now drill down to our 5-minute chart. We've got the 8, the 13 and the 21 moving average. What we're looking for, we're looking to see these starting to change and fan out in a particular direction. They've got to be nicely fanned out. That is confirming now that we're looking to enter this trade. But we're waiting for a pullback. So you can see here, market has moved up, it started to fan out, it started to move back down, and market is trading back down. We're looking for a pullback, and specifically, we're looking for a pullback into the 8 exponential moving average on the 5-minute chart. So for example, if this market here were to pull back and touch the 8 moving average, this is now our trigger bar. Now, this is still a valid trigger bar as long as price does not close above the 21 moving average. If it does, then the trade is null and void. All this will become a lot clearer, as I say, when we get on to the screens in a moment. Okay, so now we've got our trigger bar. So we've touched the 8 moving average. This is our trigger bar. Okay, so now we're looking to enter if it pulls back down in the direction of the predominant trend. And what we do, we look back, we count back 5 candles and look for the lowest point of those 5 candles. So we got here, we've got 1, 2, 3, 4, 5. The lowest candle is here. We minus 3 pips, and that is going to be our entry. Very simple to understand. So indeed, if the market does test and then re-challenge the direction or confirm the direction, we're going to enter our short trade at 3 pips lower than the lowest of the 5 previous candles. Now, as when you enter any trade, you should always be looking at where you're going to exit the trade in case you're wrong, because of course we're wrong from time to time. So our stop is going to be 3 pips above the trigger bar, the high of the trigger bar. So the trigger bar high was here, so our stop will be 3 pips above, so it'd be plus 3 pips. Once you've established your initial risk, we factor in our first take profit target. Our first take profit target is going to be 1 times risk. Okay, so 1 times risk will be our first take profit target. Once we exit our trade 50%, we move the balance of the 50% to break even, and then we've just got 50% left in the market, going for TP2, which will be 2 times risk. And indeed, this market rolls back down. So TP2, your risk is obviously the difference between the entry price and the stop. So your TP1 will be down here,